Is gold a hedge against stocks? What does gold correlate with? And where are we now in gold after the big rally? These are some of the questions that we're being asked, and I would like to spend a little bit of time today in this podcast addressing these questions as gold has increasingly become interesting for people in their portfolios this year. Hey everybody, Serge Berger here from the Steady Wealth podcast. I would imagine that from a correlation perspective, you've asked yourself, or maybe you've heard people think gold might be a good hedge against stocks. And so I would say, let's start at that little point. If you're watching this on YouTube, you are going to see the charts. If you are listening to this through the traditional podcast avenues, I will be explaining these charts to you. You're not going to miss a thing. Before we even look at the correlation of stocks versus the price of gold, or gold versus stocks, however you want to look at it, let's first just build a bit of a base case of what gold has been doing. Gold has this sort of phenomena over the years where, very much like, by the way, other asset classes too, it tends to have a big move and then go nowhere for years. And this might be shocking to some people that are new to the markets, but stocks can do that too. The US stock market can do that, and it will do that again at some point. So that's a bit of a reminder about risk management. But just looking at the price of gold, we had a big surge from 1976 into about 1980, so about 3-4 years. And then basically gold did absolutely nothing on the upside all the way, believe it or not, until, let's call it, 2008. That's a long time for something not to move higher. And then we had a big rally in gold from 01, or let's call it the year 2000, into 2011. And then we haven't really had any real upside until literally just a few months ago. So gold's basically breaking out. And that's what, if you're wondering, that's what all the hoopla is about. And as the price of gold has pushed higher this year, I've seen more and more people, as I said before, ask themselves, should I buy gold because for when stocks go down? And that's not really traditionally the reason from a portfolio perspective why we want to buy gold, but let's address this. So the second sort of point we want to make here is by just having a very simple correlation analysis between the price of the S&P 500, which, if you can see the chart, is in orange here, and the the price of gold futures, which is in blue. And over time, directionally, we're seeing the same movement. We are seeing gold go up and stocks go up, and that's largely because of inflationary pressure. So gold tends to be pretty good at keeping our purchasing power. However, the question we want to really address, which is what I think a lot of investors are asking themselves, at least on the do-it-yourselfer side, is gold an actual hedge against stocks? And let's have a look at this. The reason why people want to buy gold, or the people that ask themselves, should I buy gold against stocks, it's for if stocks take a hard dip. Typically, that's actually the worst possible time to be owners of gold. And there's a reason for that. So let me quickly share with you a couple of historical nuances. So for example, if we take the period of the year 2000, where the equity market topped, which was also known as the internet bubble, stocks topped, but gold in that initial phase of the sell-off actually fell as well. That's the blue line, if you can see the screen. So the point is, during exactly that point in time, when an investor who, for the reason of protecting his equity portfolio, may have bought gold, the price of gold also went down. What about if we fast forward to the great financial crisis? What we saw there was the equity market's initial downturn. Yes, gold went higher, but as it became clear to investors that this is going to be a bit more problematic, and they started getting margin calls, and I'll go into this in more detail in a minute, the price of gold also went down. not as much because it's not as volatile, and it bottomed before the equity market, again, because it's not as volatile, but it also went down. I'm going to show you one more example of this, and that would have been essentially during, let me fast forward a bit more, during the COVID, or not actually, not, yeah, during the COVID crash. The COVID crash was extremely quick, so that's actually not a good example, but will quickly talk about it nonetheless. So during the COVID crash, remember, stocks really were only down for the better part of about a month, and then they started rebounding very sharply, so much so that by the time we got into the latter part of the summer, the equity market rally was basically erased. But here too, during the actual shock phase of the equity market, and typically this happens at the capitulatory part of the equity market sell-off, the price of gold also went down. And let's talk a little bit about why that is. Let me bring about another, again, I'll bring back the example of the great financial crisis here for those people that can see the chart. And you can see, again, the blue line, which is gold, versus the S&P 500, which is in gold, in orange, again, positively correlating. So why does this happen? And why is, and here's the summary basically of this little point, why does gold fall when the equity market goes down? Well, first of all, gold doesn't drop just when stocks go down. What has to happen in order for gold to go down when stocks go down is investors, equity investors, have to start to get margin calls. And what does it have to do with gold? When investors get margin calls, in other words, when equities start to get to a certain pain threshold, and that is different each time based on the volatility, but once investors start to feel pain, and no, that does not happen with the S&P's down 2 or 3%. The S&P does have to drop quite a bit more than that, but maybe north of 5 to 10% is where gold starts to react, maybe quicker depending on the environment. Like right now, gold's very overbought, so it could react quicker. But what ends up happening is because people get margin calls in their stocks, they have to sell other things to create liquidity to meet those margin calls. And one of those things that they tend to sell is gold. So again, if you ask yourself, should I buy gold? Because if the stock market crashes, gold's going to go up, then historically speaking, at least, that would not be a very good decision. So why does it make sense to buy gold, if at all? Gold has a positive correlation, as I said before, to a lot of risk assets, believe it or not. And this is, I think, again, one of those things that is essentially a big misconception. So if you ask yourself, should I buy gold as a risk asset, that may also not be the right answer, but gold does a pretty good job of keeping our purchasing power, protecting our purchasing power. So again, we compare a chart of the price of gold versus the chart of the S&P 500. Directionally, over the long period of time, they have gone up because of the inflationary pressures in the markets, at least in this sort of super secular era that we live in. And to bring this home a bit more, let's have a look at the correlation, or discuss the correlation of gold, and then we'll talk about gold miners as well. But let's start with gold versus, let's say, commodities. So what I'm going to bring up here is a chart, or bring up the point of what has gold done over the course of, let's say, the past 20 years versus, let's say, other commodities and versus stocks. So if I go back to, let's say, all the way to the year 2020, roughly speaking, the one asset that has done better than all the others is actually gold. So somewhere near, actually this goes back to 1998. Let me be a bit more clear. Let's say roughly, let's go back to the year 2000, and the price of gold has done better than pretty much anything else out there. The S&P 500 is up 233%. The price of gold is up 750%, and commodities, all for the most part up as well, except for natural gas, have all positively correlated to that trade. So again, I ask yourself, why buy gold if it's positively correlated to other risk assets? Because A, it tends to be somewhat less volatile, and B, it does a better job at protecting our purchasing power. So those are two important reasons we believe, to be considering an allocation in gold. Again, this is obviously not investment advice or financial advice. What about gold versus something a bit more granular, like but agricultural commodities? So the correlation of gold and agricultural commodities is extremely high. If you can see the chart right now, what you would see, or what you do see, is essentially an extremely high correlation, positive correlation, where if agricultural commodities go up, the price goes up, or vice versa. So again, it's not something that is going to protect us versus agricultural commodities or commodities. It's simply a purchasing power hedge. So why is it that right now we are seeing the price of gold go up? A lot of reasons. Central banks are buying gold. Why are central banks buying gold? Diversification. Some central banks outside the United States are a little bit concerned. So we hear about the United States potentially freezing assets, dollar-based assets, so they buy gold instead. All sorts of reasons like that. Again, we have the issue of higher inflation, lots of printing money, global debt problems. These are all reasons why the price of gold is going higher. Let's talk about one, maybe two more points here. And let's start off with gold versus the yield of bonds. So or let's talk about it in terms of the price of bonds. Is gold in general a hedge against higher interest rates? And this is where things get tricky, because if we compare gold to real actual interest rates, it's not very helpful. Where gold becomes extremely important as what really drives the price of gold, it all has to do with real interest rates. And for that, I'm going to show you what that looks like. So there's an inverse correlation of the price of gold versus what's called real interest rates. And before it gets too confusing, let me simplify you. Two lines, again, if you can see them. If not, don't worry, I will discuss this. We have the price of gold, which is in blue, and then we have a red line here, which is the real interest rate. So what the real rate of interest is, the actual interest rate, the nominal rate, let's say being paid by a 10-year treasury note, minus the correlating or the appropriate rate of inflation. So if, let's say, a 10-year treasury yield yields 4% and inflation is 3%, then the real interest rate is 1%. There's an inverse correlation between the price of gold and real interest rates. So if real interest rates go down, the price of gold goes up. Okay? If real interest rates go up, then the price of gold tends to go down, or at least doesn't rally in a big way. It's not a perfect relationship, but that tends to be what happens. So that's the basics of that. Last but not least, let's talk about the thing that gets traders a bit more interested, and that's really, what about gold miners and the correlation of gold versus gold miners? How does that look? There is, from what I can see and I sense, there is this belief that gold miners are going to go up when the price of gold goes up, almost without questions asked. And it's simply not necessarily true. The price of gold, depending on what drives it, whether it's central bank buying or lower real interest rates, again, it always depends a bit on the cycle. The price of gold, like for example, right now is breaking out, and gold miners have not done so. And it's because, I think, at least in part, because central banks are not buying gold miners, they are really just buying the gold. However, there is a long-term positive correlation between the price of gold and gold miners. Remember, gold miners are companies, so they have to deal with cost margins, rising costs as well. So there's business cycles as well that a gold miner has to deal with. And there is a positive correlation over time, but it is really important to understand that gold miners are volatile. ETFs like the GDX are some that people like to focus on. There's even like smaller mining stocks that people or ETFs that people like. So just keep in mind that gold miners are extremely volatile, and that is something that we want to be mindful of. So gold miners are not, in our view, a replacement for the price of gold. It is a different thing. They're more trading vehicles in that sense. It's more volatile. And again, not something in the aggregate that we would say is something to allocate a whole lot of capital to. So to summarize, gold is not a good hedge versus stocks in times of crises because of margin calls. Gold does tend to, over time, positively correlate with stocks, with risk assets, such as gold miners, but also with commodities and even agricultural commodities. And gold is, in our view, a decent inflation hedge, but it also does tend to, over time, correlate somewhat inversely with the level of real interest rates. So there you have it, a bit of a little bit of a deeper dive, if you will, on what drives gold. I hope this was helpful for you to demystify some of these things about gold. And I look forward to seeing you in the next Steady Wealth podcast. Thanks for listening.